From West Virginia.
I was like,
Sorry.
Hillbilly from West Virginia.
That's right.
White trash. But,
In the next episode, I head over from Hong Kong to Singapore, where I kick off Token 2049 with a Connected Capital event. There, I experience the amazing food culture and hawker stand culture of Singapore. My first interviewee, Dave McClure, is the founder of 500 Startups, the famous accelerator, and Practical VC, a fund focused on secondary sales of startup equity. He's also a friend, mentor, advisor, and helper of mine, and always been a backer of my efforts in the startup world. So I hope you enjoy the episode. Cheers. Cheers.
ching ching.
Welcome to the show. Special guest is Dave McClure. I just found that you were in town just yesterday. And, Token 2049, I was checking basically your updates on Facebook, and you said you were in Singapore. So I said, hey, let's come together.
Great time.
Last time I saw Dave was in Silicon Valley, probably earlier this year.
Sometime earlier this year.
Something like that. And then
we also met up in Tokyo once or twice, in Hong Kong once or twice.
We did. You remember our time in Tokyo?
Yes. You went to that Japanese spa.
That's right.
That was
Lakwa.
That was awesome.
You generally do go to like onsen, right?
When you go to onsen, but I usually stay there with my mother-in-law, so I'm not going. We go outside Tokyo,
right,
and go someplace,
right.
But that was the first time I'd actually gone in Tokyo.
Right, it's a good place actually. It's one of my favorites. So we're having lunch at the Newton Hawker Stand, and we just ordered from the Michelin star.
Allegedly.
It didn't look like the real Michelin Man. But so we had roast duck, sweet roast duck. We have spicy noodles. We have chicken rice, and then the bean sprouts. So it's all in the taste. So we shall see. But this is lovely. Did you get any of the noodles?
Tasty.
Is it?
I'll get them in a second.
Okay. So yeah. So what are you doing here in Singapore?
Well, as I like to say, usually if I'm breathing, I'm raising money for a new fund.
Right.
Working on a third fund for our secondary vehicle.
Oh yeah. Really good.
Good?
All
right.
Really good. And so you're here for about a month, right?
Not quite. About 2.5 weeks. I'm speaking at Super Return on a secondary panel, I think on the 20th or 21st.
Are you doing Token 2049 stuff as
What's
well?
That?
Are you doing Token 2049?
I might stop by. I mean, I'm not the super crypto dude, but I have a few friends who are in town.
Right.
Probably drop by Milken event a little bit.
And then afterwards, you've got your 42 geeks as well.
We're taking a bunch of people, about 42 of them actually. I think a little bit more than 42 this trip, to Taiwan, Korea, and Japan. And going to be hosted in Taipei by an old PayPal colleague, Steve Chen, who's a founder of YouTube. And
he's a PayPal colleague.
Yep, used to work together way back in the day.
Right.
And then Kevin Lin also is a founder of Twitch.
Right.
I think supposedly Mayor Taipei is supposed to drop by. I don't know what that's about, but I guess that's cool.
Allegedly, supposedly.
No, I think it's for real. But
is it? Okay.
I don't know. So we're in Taipei for about 3 days, meet up with some startups and some other investors. And then we're in Seoul for a few days. Same story. And then Tokyo, we're doing a 1-day conference, VC conference, called Nippon Novation.
Nippon no innovation.
Nippon Novation.
Right. Nippon no innovation. So this. Actually, how has what is that going to be about?
Well,
you said it's going to be in Tokyo.
Yeah, we're bringing about half of our group are other fund managers, VCs, meeting up with other Japanese VCs and LPs and some government folks.
Right.
And there's been a big push in Japan over the last couple of years by the Kishida government to try and increase the size of the venture capital ecosystem in Japan.
They're doing a matching scheme, no?
I don't know all the details. That's part of what we're going to be finding out. But I believe there is capital being put together.
Right.
And I think some of that is for domestic Japanese funds, and some of it is outside Japan funds as well. But I think just kind of hearing how they're planning to try and do that, and maybe we can help with some of that. I've done a bunch of investments in Japan and raised some money from Japan for when I was running 500.
Right. Miss Taizo-san.
Taizo is actually going to be one of our speakers. Yeah, Taizo-san is one of my former LPs, investors. And should have some great folks. So it'll probably be about 100 people or so, but
that's good.
About 30, 40 people from the US, maybe another 50 to 100 people from Japan.
Okay.
Some corporate VCs and some government folks as well.
Actually, how has that Japan scene evolved? So I had one question around there. I also had another question of how has 42 Geeks also evolved, right?
Oh, yeah, right. Well, this is kind of a rebooted Geeks on a Plane.
Right.
We used to do that way back when I was running 500. We kind of took some time off, and then a friend of mine, Chok Oi, who was an entrepreneur out of Malaysia, now lives in the US, and he had come on a bunch of our trips, and he really enjoyed that. So he pinged me and said, "Hey, we should really put this back together again." I was like, "Okay, we'll put a new brand together called 42 Geeks." Which is
because 500 owned the other brand?
No, not really. I think it was just time to start a chapter. Right. I guess there's a little homage to the Hitchhiker's Guide to the Galaxy.
Right.
It's also about the number of people you can fit on a bus.
Right.
Anyway, it was a domain that was available, so we'd write it. But same kind of story. We've done 3 trips over the last year.
Middle East?
We did Southeast Asia last year. Actually came here, and Vietnam and Thailand and Bali. And then we did Middle East in February. Went to Israel, Palestine, UAE, and Saudi.
Right.
And then just a few months back, we went to Latin America. We did Brazil, Argentina, and Uruguay.
Right. So Geeks on a Plane was my understanding of it. I've never attended. I wasn't invited back then.
Oh, really? You just invite yourself.
Yeah, I know. That's true. I know. They has a very open door policy.
We did not invite you.
Exactly.
That's a fail on you, buddy. The test is, can you invite yourself?
Can you invite yourself? Yeah. So back then, my understanding was very casual, very just kind of come together, understand different ecosystems.
It was really just, an opportunity to get a bunch of people together who wanted to learn about tech in other countries. Right. To some extent, it's a little bit of a marketing vehicle for 500 when we were getting that off the ground. Although actually we had started it even before 500 when I was at Founders Fund.
Really?
Christine Liu helped us put the first trip together.
Oh, right. Okay.
But
yeah,
we used to do them like about 3 times a year for, I don't know, at least 6-7 years. So
right.
It must have done 30, 40 countries or something.
Yeah. So yeah, has that evolved? Because like back when you were starting to do it, like tech ecosystems in Southeast Asia wasn't as big, in Latin America. So now on this front, there's a lot of founders now, a lot of VCs.
Yeah, I mean, definitely some big changes. We went back to Vietnam and Thailand. That was the first time I'd been back in about 6-7 years. And both of those ecosystems have really grown dramatically. Vietnam's really on fire. There's a lot more here in Southeast Asia overall.
Right.
We had started investing in Southeast Asia, I think, back in 2010. Vicky was one of our first investments over here, which was acquired back around 2013, I think. And then Kylie and Vishal came on board and were running 500 Southeast Asia. I think their first fund was started around 2014. I think they just announced they raised their 3rd fund just a few days ago.
Oh, I see. Okay. Congrats to that. Yeah.
So kind of the last 10 years, I think there's been a lot more activity in Singapore particularly, but all over Southeast Asia.
Right.
And then, around the world, I think varying levels. Certainly a lot has happened in the Middle East. In Latin America, definitely there's been growth, but SoftBank, sort of had a big commitment to the market with SoftBank LATAM fund, which is like a $5 billion fund.
Right.
But then they sort of, I guess, pulled out of the market even a few years before the downturn sort of kicked in.
Right.
So there's been a lot of growth in Latin America, but maybe not as much late stage capital as they could use.
Right.
Certainly, it's been more funds started in Brazil and Mexico, and a lot of stuff happening now in Colombia and Chile and
Right.
other countries. But still, I would say relatively undercapitalized
Right.
compared to the opportunity.
And the exit opportunities in Latin America are usually still the U.S., right?
Well, yes, but there have been some Brazilian IPOs.
Right.
I think probably the larger IPOs have been in the U.S. market on Nasdaq. So I think Nubank and dLocal, which is a payments company out of Uruguay, way back. Mercado Libre, which is now a $70 billion company. But I think most of those companies are still either going public on the U.S. market or
Right.
are getting acquired by other global multinationals.
Right.
I'm not sure how big the Brazil IPO market is, but there's probably some opportunities there too.
Now, Southeast Asia is mostly the exits are Singapore or the U.S. And then in the Middle East, you're probably there looking at just LP relationships, or is there a growing domestic market for founders as well?
There is a market in the Middle East as well, and
Really?
again, we had started a fund in the Middle East, actually two different funds in the Middle East when I was with 500, called 500 Falcons. That was out of I guess they had partners in Bahrain and UAE and Saudi and Egypt.
Right.
And then there's another fund in Turkey.
Oh, wow. Okay.
So those funds are still operating. 500 has a very significant partnership with Snobble out of Saudi. Overall, Saudi market and UAE market have really grown. Mubadala and Adia ADQ are large sovereign wealth funds out of UAE.
Right.
And the Qatar Investment Authority out of Qatar, and then you have several funds in Saudi, private investment fund or PIF.
Right.
I think there's the Saudi Venture Capital Fund of Funds program that's run by Dr. Nabil Khashak. They've invested in, I think, over 50 local Saudi and Middle East VC funds. Jada is another group there that's a fund of funds. So there's been a fair amount of large, fund activity. The sovereign wealth funds in the region, do lots of investment. Venture capital is just a small piece of that. But then I think certainly a lot of startups that are being started in Egypt, in Dubai and Abu Dhabi, in Saudi, and some of the other countries around there too.
And then Africa
all these markets are still developing. And Africa has certainly been more activity. I would say that's still not, huge. But you have pockets of activity all across the continent, particularly Nigeria and Ghana and West Africa.
So where the domestic market,
Kenya and Tanzania and East Africa, South Africa.
So where the domestic market is big enough. There's a big enough user base. And
even in places that are smaller, you're seeing, startup activity, although not quite as many funds maybe in those places. I think in Africa, it's definitely, West Africa, East Africa, South Africa, to some extent, maybe Egypt and Morocco.
Right. And then, and please have some food. It looks like it may rain. So hopefully it won't. And the food's delightful. But this is very spicy. This is spicy, but it's like Korean spicy.
Oh, it's not that spicy.
Yeah, it's not that spicy. But this is good.
Only for white people.
But bean sprouts are really good.
Yeah, definitely. The bean sprouts
are really good. Yeah, they're really good. And then the crispy duck, I made the mistake of not actually adding the sauce. So it was a bit dry for me.
I was dipping in the hot sauce, but
that helps,
I should probably try some of this.
Yeah, so when I think about so when you're talking about like globalization and all these different funds, and that's for 42 Geeks, that's awesome, right? So a lot of people are interested. But then there's also this kind of other narrative, which is, this decoupling, right? Because the U.S. is focused on the U.S.
Well, I think
focused on China.
China has certainly got some challenges ahead, and there's been a huge U.S.-China sort of decoupling. Although, actually, I mean, with all the noise about the decoupling, I think that trade between U.S. and China is still at an all-time high.
Right.
Although, growth has probably slowed down a little bit. But yeah, I think, there's probably, I think it's going to be difficult for startups to sort of, operate in both places. So
Right.
probably people will have to choose either the Chinese ecosystem or the U.S. global ecosystem.
Because in the U.S., Chinese investors cannot invest.
That's not completely true, but
Yeah. What is? Or sorry, upon approval, right?
I mean, I'm not the expert. Consult your own legal, but I think for areas that are
Right.
focused on AI and cybersecurity and
Right.
anything fintech, that's probably difficult.
Right.
But there's corporate entities from China that have dollars outside China.
Right.
I think depends on how the people interpret the CFIUS rules.
Right.
Probably not direct investment in anything where they're involved on the board, but
Right.
maybe as a passive investor, perhaps.
Right.
Yeah.
But
there was a lot of Chinese investment in U.S. companies and funds, and a number of those have had to either unwind or sell their positions,
Right.
Both because of the U.S. government and because of the Chinese government, I think.
Right.
But it's not just the U.S.
Yeah, so I was going to say, yeah.
I mean, there's a lot of difficult scenarios. China's still a huge trading partner for probably a large number of countries all over the world.
Yeah.
But it does seem like there's a lot of people now rebuilding supply chain infrastructure outside China.
Yeah.
We see some significant benefits in Vietnam.
Right, exactly. Yeah.
Also in Mexico, probably in India.
Right.
So there's both some challenges and some opportunities as a result of that. I think unfortunately for China, they have some really significant challenges with population slowing down, demographics moving in the wrong direction, probably a very large real estate crisis that it's already happening.
That's right, exactly.
Horizon,
That's right.
Already happening.
Yep.
And just a lot of other factors that I think have made it difficult for entrepreneurs to operate in China unless they're really plagued by the Communist Party rules.
Yeah, but have you noticed like a lot of, how about India? So because, so a lot of American investors cannot go.
Yeah, definitely. I would say, India is probably one of the largest benefactors of all this activity. And I mean, India was already a huge factor in growing and a lot more, tech activity, but they're benefiting from cheap oil coming out of Russia. They're benefiting from, a lot of business dollars.
They actually play their cards right with the cheap oil. They're like, we're a sovereign country that need oil.
No comment, but certainly has been to their benefit.
Yeah.
We'll see kind of how that was, but India is a super large country and continuing to grow and has exactly where they are. Global economy, they're in the top 10 for sure. I'm not sure about top 5, but maybe close.
Right. So do you have a 42 Geeks trip planned to India, or do you think?
I think we'll probably do that in the next year or two.
Okay.
We did trips in the past in Geeks on a Plane to India. And certainly there's a lot of activity all over, but particularly Delhi, Bangalore, Mumbai.
Right. Okay.
Probably a few of the other provinces as well.
Because surely, out of all the regions that we just talked about, India must be for you the most exciting from an investment perspective.
Well, I mean, I think it's all exciting. From a large population perspective, it's probably the biggest market.
Right.
From a dollars perspective, I'm not sure. I think I'm wonder Southeast Asia might still be
really
larger, but I'm not sure those numbers. You may be correct. India might be larger. I think Latin America is interesting just because we're in the U.S. and it's overlooked.
Right.
And the connectivity of the U.S. market is pretty strong.
Right.
Again, all the nationalist bullshit aside, there's a huge amount of trade between the U.S. and Mexico that is increasing.
Right.
There's a huge amount of trade between the U.S. and the rest of Latin America.
Right.
Definitely a lot of opportunities to get companies all over Latin America. Tech is huge opportunity there.
Right.
So although it's a tough time in the market for venture right now because of what's happened the last year or two, I'm still very optimistic about the global opportunity.
And so I was going to that. With higher interest rates. So one of my theses was with higher interest rates, there will still be demand for venture capital because your risk-free rate is higher, right? But you still want those outsized returns. And venture capital is probably the only one of the few asset classes that still offer
Well,
return.
that's true, but it's challenging to make money in venture, and
Yes, overall.
the adage that venture capital on average does well, but in the median case does not. So venture capital works on an aggregate basis because a few outliers, both companies and funds, do well.
Right.
But the average company and fund does not do well.
Right.
So diversification is important, and luck is important.
Right.
And I think globally people still recognize that investing, innovation are very important for those countries.
Right. Okay.
If you look at the U.S. economy, I think I'm not sure, but probably 7 of the top 10 most valuable companies in the world are tech companies.
Right. Right.
So
you're saying
more than half of
yeah.
Nasdaq was
Right.
venture backed.
Yep.
So I think people around the world are still chasing the Silicon Valley story and dream.
Oh yeah. Okay.
Even though we might have gotten a little ahead of ourselves
Right.
the last year or two.
Right.
But interest rates do drive a lot of valuation activity.
Okay. Okay.
So that's probably been the reset that everybody's still going through right now.
So actually, last time we chatted, because right now you're focused on secondaries, and so last time we chatted, you were saying there were still valuations are going to come down, right? And have you started to see
the
that?
case.
Yeah.
I mean, we saw a tremendous amount of opportunities in secondaries starting around March when the Silicon Valley Bank collapse happened.
Right. Yeah. Right. Yeah, we met before that, didn't we?
Yeah. So
Yes.
so last year.
No, we went right after FTX, but before SVB.
Oh, right.
Because I saw
that was another
Arthur.
crazy.
I saw Alfred. Yeah, because I had dinner with Alfred. I asked him about FTX.
I'm not going to dive into that one. But...
no, on record, he said he had the last conference with him before
SBF.
Yeah, before it collapsed. It's like I couldn't tell.
Yeah, I think it would have been interesting to know what was going through his head at the time. Sam's anyway, but so the overall market correction probably happened around Q1 of 22. But
22, right?
But we really didn't see the secondary opportunities emerge until later in the year and earlier in this year.
Got it.
So there's a lot of everybody sort of took their foot off the gas, said, "Holy shit, let's wait up for a second, figure out what's going on."
Right.
Starting in Q4 21 and Q1 22, valuations in the public markets changed. Everybody in the private markets sort of took a second to sort of figure out what was going on. And then since then, you've really seen a pullback on activity and valuations.
Got it.
In the private market, although only on new rounds that have been happening, not so much on existing companies.
But that's also because they haven't.
Well, everybody's trying to avoid.
That's right. Yeah, that's right.
Music.
That's right.
I think people know that company valuations have got cut in half, or in some cases even more than that. Certainly, valuation multiples in the public markets have come down, in some cases by as much as 70-80%. But private companies who still have capital and haven't had to face down rounds yet, have not really reset those valuations, at least on the books.
Sure, right.
And in particular, the VCs who invested in them haven't usually.
They try not to. Yeah, that's right. They don't want to mark down.
Assets proactively until there's an actual market event.
Right.
Which has resulted in a lot of companies and funds on paper
still doing very well.
Still hanging on to 2021 valuations, which is certainly not correct. But I think starting from when the SVB collapse happened, perhaps as a function of just people gradually running out of money, we started seeing a lot more people come back to the market, willing to sell at much lower prices. And we got a lot busier.
Yeah, so I'd imagine, right.
Starting around Q2. And certainly for the last 2 quarters, we've been pretty busy.
Got it.
Doing a lot of great deals, in our opinion, both U.S. and global.
So a lot of is the founders that want to exit? Like, I just want to know more about your business.
We buy at the fund level
as
well as at the company level, but more of what we do is at the fund level. So typically we're buying from LPs in funds, investors in funds, and sometimes the GPs or VCs of the funds. We also will sometimes buy from founders or employees of companies.
Right, but that's harder. It's not really scale.
It's harder. There's just actually more. In fact, I would say the opposite. The funds are harder just because most people don't know about them, and it's a little bit harder for people to price and value those assets. But you also have these marketplaces
Yes.
for direct secondaries or
Yes.
individual company
Right.
secondaries. Forge, Equities N,
Right.
Stonks is another platform that's now
Right,
doing
sorry.
secondaries, several others. But that's a little bit more of a retail marketplace.
Okay.
There's private buyers who are larger entities.
Right.
There's plenty of brokers, but most of the fund level activity is not very well visible. Not
Okay.
most people don't know about those deals when they happen, and
Right.
and they're really hard for the average investor to underwrite.
And so let's go through that process a little bit. So a fund says, I want to sell my stake. How do you go through the valuation? That's really the match. I mean, that's really the money
Well,
shot there. You're like,
a lot
you
of
know,
art-
discount.
art and not as much
Right,
size.
right.
But we would do that the same way we would value an individual company, just that there are several companies to
Sure,
value.
right, a
And so
portfolio,
kind of
yeah.
do a bottoms up analysis of
Okay.
there's three groups. There's the companies we think will have an IPO event that are
Yep, the
hopefully
unicorns. Yep.
probably a couple $100 million in revenue, maybe
Okay.
on that track.
Right.
There's another set of companies that maybe look like they're headed in that direction, and
Right.
maybe they'll get acquired, maybe they'll go public, but
Right.
probably doing 30, 50 million in revenue and up, maybe series B or C or later.
Right.
And then there's kind of everything else, which is maybe smaller, maybe not growing quite
Right.
as fast, or just earlier in their
Right.
process. And we don't really ascribe a lot of value to that
Right.
group of companies, or at least we can't guarantee exits there.
Sure. So you do a weighted average.
We look at the
So-
first two groups.
Yep.
We try and value those appropriately. We probably discount that in a way that hopefully we can make money.
Right.
And then we try and reach a compromise with the seller on whether that's a number that they're interested in. For a lot of folks who might be holding something that could be worth 3 or 4x on paper, maybe they're willing to take a
Right.
1.5 or 2x
Right.
exit in cash.
So during this kind of Q2 kind of process, have you noticed that discount has gotten more heavier? And two, are the VCs coming to you and saying, we want it because we want to convert it to cash?
Well, I think it's mostly the LPs or the investors and funds that we're talking to.
Okay.
We do need consent from the general partner to take over those positions. So it's sort of like we're buying out an LP, one or more, and becoming an LP in the fund, or we might be buying out a position from the general partner, becoming sort of like a silent,
Right.
Partner in their fund. But we're along for the ride with the general partner and the other LPs, and so usually there's a conversation that involves the whoever's managing the fund to figure that out. And there could be right of first refusal to other investors in the fund or other entities. Certainly that's the case when you're buying direct. Secondary, usually approval by the management of the company and or the board.
Right. Actually, I didn't factor in the fact that once you buy the position, you're right, like another LP and
Yeah.
or a silent GP. So you're also in for the long ride.
Well, not as long. Right?
Not as long,
So
but
we're typically coming in
right,
between year 5 to 10, maybe around year 7,
right,
which we would sort of say usually is about the halfway point.
right,
Most VC funds are structured as 10-year vehicles, 10 plus 2 years really.
right.
However, most VC funds end up really taking more like 15 years.
Right,
In fact, some
right.
of them take longer than that.
Right.
A lot of companies that are going to an IPO will take 10 years, sometimes even longer. So around year 7 is kind of when we are interested in buying those positions. We
Right.
kind of say we're cutting a VC fund in half and buying the back half.
Right. Okay.
And for
yeah.
a lot of people, they may have been in a fund for a long time and are looking for liquidity before the fund is over.
Right. But then do you kind of add any protections or do you help the management team think about exits and potentially think about
We
accelerating?
may, but we're pretty passive investors for the most part. We're
Got it.
we're not taking the same role that a normal VC on the board
Okay. Got it.
would. Again, most of the funds or companies that we're getting involved with are fairly far along in their trajectory. So for the most part, the funds that we're buying into have been fully deployed, and they're simply just waiting for exits.
Okay.
Even if those VCs are involved in the board, we usually are not.
Got it.
So we might have a relationship with the founder.
Right.
We possibly have a relationship with the VC.
Right.
But for the most part, we're relatively silent investors after we pull the trigger on the deal.
Right. And how many funds have you invested in or
It's been a combination of funds and companies, but probably about 20 overall positions in the last. Well, this is our second fund, so we've been investing out of this for a little over a year and a half.
Right.
It's Probably on the order of about 10 or 15 funds, maybe another 5 or 10 companies.
Right. And then and then mostly US based.
Mostly
Yeah.
US based, but we've done deals outside the US in Africa, in Middle East, and Latin America. We've looked at stuff here in Southeast Asia and India as well.
But the prime metric is really year to or time to exit, basically,
Yeah,
in the portfolio.
Again, there's a certain amount of maturity that happens in these funds about 5-6 years in, where they've deployed most of the capital, they've made most of their bets, they've seen whether those bets are working or not.
Right.
Usually, it's a minority, probably only the top 10 to 20% of their portfolio that's really driving a lot of the value.
Yeah.
And by around year 4, 5, 6, most of the bets that haven't worked out have been written down or written off.
Right.
And so for a lot of funds that might start out with 30, 40, 50 companies, there may only be really 3 to 5 companies that are driving most of the value. And in some cases, it might be just one company that's driving most of the value.
Yeah. Actually, having worked with so many funds, running 500, worked with so many funds, and did deal with so many funds, would you say, what makes a good fund?
Well, it's a lot of luck.
Yeah, really? Yeah.
I mean, there's all different reasons why funds, can be successful. And everybody likes to think that they're smart because they have great deal flow.
That's right.
They help the company.
Yeah, but give us
we're not really trying to have a strong opinion about why. We're just looking at the results.
Yeah, but give us a skinny. Like, have you thought? Like,
well,
is there
certainly some people who are consistently good at their job, and there's other people who get lucky at their job, and maybe by around the second or third fund, you might be able to tell which group people are in.
Right.
In some ways, when you're buying secondary positions in these funds, you're sort of getting a due diligence, look on the fund manager.
Yeah, 100%. That's the question.
In the rear view mirror.
That's right. Yeah.
But still, it's not always a one-to-one mapping with performance and potential.
So you can say you can have really good fund managers and just be very unlucky. Let's use the counter.
I think over time, good fund managers and good funds tend to go together.
Of course.
But on any given particular Sunday or any particular fund, idiots can get lucky and geniuses can do poorly.
Right. So if a fund manager says, first fund, because a lot of fund managers, emerging fund managers, will go, I'll raise the first fund. Very quickly, they have to raise the second fund. But the first fund, still not that many early successes.
I think it probably takes 3, 4, 5 years for you to see progression in a portfolio.
Okay.
Let's say, from pre-seed and seed to maybe A and B.
Let's say the seed fund. Yeah, let's just say,
from a pre-seed to Series B might be a 4 to 5 year journey.
Got it. Okay.
Certainly even from seed to A is probably 12 to 24 months, sometimes longer.
Right. Okay.
We probably want to see progression, not just from one round to the next, but multiple rounds.
Right.
Probably once companies are starting to do, I don't know, I guess I would say 10 million in revenue, Series B or later, you kind of have some sense that they might be successful in the long run.
Right.
That usually takes 4 or 5 years.
Got it. Okay. To have enough sample size and data.
I guess I would say if you saw a fund that started out with 30 investments at seed or pre-seed, and they got 5 of those to Series B, they're not just lucky, although maybe in the last 5 years, everybody had a lot of luck.
Right.
I think in the next 2 or 3 years, we're going to see a lot less luck and a lot more talent.
Right.
But I think probably progression from round to round for most investors is not much more than 30 to 50%. Maybe there's a few folks who get above 50% progression.
Right.
If you're looking at, from seed to A to B, probably I would say people are going to see anywhere from 10 to 30% progression.
Okay.
And so you might only see 1 out of 10 companies make it through that. Maybe for a really great investor, you might see 3 or more companies make it through that progression. But you're going to see a concentration of portfolio value in a smaller number of companies.
Right.
And I don't think you can draw too much from just 1 or 2 years of activity.
Yeah, there's not enough sample size data.
And a lot of it does have to do with market conditions as well.
Right. So you got to time that out. Now, have you also noticed similarities between geographic areas?
Well, I think in areas where there's less capital availability, it generally takes longer for those companies to make progress.
Got it.
And so obviously in places like Silicon Valley, New York, similarly London and maybe Singapore in the past, Hong Kong, Beijing, Shanghai, those places have plenty of capital. I don't think that's been too much of a problem.
Right.
In more emerging markets and ecosystems, certainly in the past, there's just not as many investors, and those companies either have to bootstrap their way to growth, or they have to work at it a lot longer.
Right. Okay.
So companies do tend to take a little bit longer.
Right. And then the manager also, in consequence, the manager also needs, instead of 3 to 5 years, maybe 5 to 7 years.
I think that's true. In a few cases, you might see, because some of these markets are very active, you might see fast growth.
Sure. Right.
But in general, I would say the amount of capital in those markets historically has been less, and there's been a slower path for the companies as a result.
Switching back, so actually, no. One question I didn't want to. You said there's not that many people doing actually secondaries, working with funds.
Well, there's a lot of people that have done secondaries in private equity, and most of that is at the fund level.
Right.
There's a fair number of people doing secondary in single companies, at least in the U.S.
Right.
And there are marketplaces for that activity as well. For funds, there's not generally a lot of activity.
But why is that though? Is it just?
It's just harder. Again, you're valuing a basket of assets instead of a single asset. You're probably not aware of those assets for sale unless you have a strong network of LPs or GPs that you talk to.
Got it.
You can't flip those assets as easy. So if you decide to change your mind about an individual company, secondary, you might be able to sell that back to somebody else.
Right.
For a fund, it's very difficult to find buyers.
Right.
And so as a buyer, you might get a great deal, but you're probably in a buy and hold scenario for most of those.
So most of the time, your leads come from the funds themselves or the LPs?
People we know. Yeah, well, both. The VCs and the LPs. But I'm just saying, there's not really, at least not at the moment, there's not very many marketplaces that list fund assets for sale. And so you just don't know about it unless you happen to have a good network of people that are doing that. And also because of what we talked about before, they may have restrictions on who buys into those funds. So they're not a known entity, and they may not want you doing that sale. So it's just a much smaller universe of buyers and much less information. You're having to underwrite multiple assets. You have to sort of have a buy and hold strategy that's for a longer period, maybe 3 to 5 years instead of just whatever you want. So there's just fewer people doing that, and outside the U.S., even fewer that do that.
I know one person. It looks very similar to you. Have you seen him in a long time? What's his name?
The guy I am Pacific. Michael.
Yeah.
Or
Mojo
is his nickname. Yes,
that's right.
I think they do some of that activity.
They
at
try
the fund level and company level. There's a few other groups out of Japan and Malaysia, I think.
Okay.
But there's not many. I think that's going to change over the next few years. We'll see more people coming in. It's a huge opportunity.
Of course.
There's nowhere near enough capital to take up all the inventory that's available, and that's true both in the U.S. and globally. So,
how did you come about saying this is right? This was I have a guess.
Well, I had my own scenario where I was trying to sell, some of my carry in earlier funds.
Scratching your own
LP
itch.
in other funds. I had a fair amount of, illiquid value on the paper, but in order to turn that into cash and buy a house in Silicon Valley and start a new fund, you have to wheel a deal. So it was a complicated process to find a buyer. Originally, I'd been looking at doing a fund of funds to invest in other micro VCs. And when I was at 500, we started a lot of small funds in other parts of the world, probably about 20 different small funds.
Oh, but you didn't inject capital in that.
No, we did. We put money into probably at least probably 15 or 20 small funds that we ran under 500 umbrella, and then we were small LPs and a bunch of others outside 500. We were a small LP in Blackbird in Australia, which is an early investor in Canada. We were a small investor in some of the seed cap funds.
Cool. With Carlos.
UiPath. And other parts of the world as well. So we did a lot of that for relationships and for deal flow and to just learn. But it's very challenging to get funds off the ground, particularly for first-time fund managers. That's difficult, particularly in unusual places outside the U.S. It's difficult.
Right.
So I had been wanting to put together a fund of funds to invest in micro VCs, and as we were sort of putting that thesis together, we kind of stumbled into this opportunity in secondaries. It was a problem that I had personally as both a VC and an LP, and wanting to get liquidity. And I was able to get a transaction done, but in going through that process, I realized
how painful it was. Because you just
I realized it was a big opportunity to go after.
Painful.
I felt like I had a good handle on what the customer was going through, and frankly, just thought it was a great investment to go after that not too many people were really into yet.
Right.
And, some larger folks like Industry and Stepstone in the U.S., but they're writing much larger checks, not as many folks in the smaller side.
Right. So also one thing that I wanted to mention was the whole 500 thing, I have to say, and I've said that I want to do a podcast with you because I really want to thank you for actually the opportunity you gave me. You helped me on my fund. But more than that, actually, we met first at Web Summit, Arise in Hong Kong. And when we chatted, I was drunk. I don't know about you. We were in a taxi cab, and I asked you, I don't know, you probably don't remember this, but I asked you, how do you balance work and life with family?
Not very much balance, actually.
And that's what you said. And you're like, it's tough. And so you have this reputation of being brash and everything, but I never saw that at all. It was always that frank answer you gave me. It's tough. And you kind of like, I'm not doing a very good job of it. And I appreciate that answer so much that,
maybe there's other folks who handle that better. I think, we were trying to grow the business in a lot of different countries. Spent a lot of time on the road, probably about 6 months out of the year, was in 20 to 25 countries a year. And, 500 was a large operation, over 100 people. We were doing 200 to 400 investments per year. And I will say I used to have hair, maybe.
What's the proudest thing that?
Well, I guess I would say the proudest thing is the 500 is still going, and my former partners are still running that, and I think now they're probably close to 200 people, and they're probably in 25, 30 countries. I think they're probably working on raising their sixth fund. I'm not sure, but they've done a great job in continuing to build the company and continue to invest in founders all over the world, invest in women and minorities, and really give a lot of people a chance.
I think that's
And that's true for people on the venture side as well as on founders. And so, that was really what I was very passionate about when I first came to Silicon Valley. Technology and entrepreneurship and investing were always things that I was excited about. And, frankly, I didn't feel like I was an insider in Silicon Valley when I came there, and I tried to pass on that.
From West Virginia.
I was
Sorry.
Hillbilly from West Virginia.
That's right.
White trash. But, I think, the thing about Silicon Valley is everybody, if you work at it, you kind of get an opportunity there. There's still some obstacles for certain folks, but it's maybe a little easier to make your way there than maybe other parts of the planet or other parts of the U.S. But we wanted to bring that opportunity globally, and
that's really.
We knew that there was a lot of really talented folks in plenty of parts of the world that didn't have access to capital or didn't have access to, get a job in venture. And
you were the first one to go global.
I don't
really,
think we were the first one, but we were certainly
in a structured way.
A lot.
Yes.
We were probably the first to do it in multiple places.
Yes. All at the same time.
Although I think, even maybe Tim Draper in the past and a few other folks had done, global efforts. But we were probably a little bit more on the ground.
Right. Yeah.
We hired a lot of people in different markets in Brazil, India, Asia, Middle East, all over Mexico. So.
I mean, you really built a lot of, it's funny how you link it with like for two geeks and building ecosystems still from the ground up and going there. You literally helped build a lot of those ecosystems up,
Well, I think you were a little crazy at first.
You needed a small dose of crazy.
But I think the math was always pretty obvious. Like if you looked at, growth in populations, growth in the internet, hopefully growth in capital availability.
Right.
It was clear there was going to be big companies that were created outside the U.S. and Europe and even outside China and other places.
But it's timing.
Well, I think it was just a question of when, right? And
Right.
so everybody was like, "Hey, there's been no historical exits in these markets. The number of startups is still relatively small. Internet penetration is still
Right.
limited. Maybe payments and distribution were limited." But you're always like, "Well, look, it's only a matter of time before Apple and Facebook and Google and other companies, not just the ones in the U.S.,
Right.
Tencent and Baidu and Alibaba also in China and others. And then even in emerging markets, you had other large companies as well. Probably initially in fintech and e-commerce, and then gradually in other areas like SaaS and education, healthcare. But I think all you had to do was look at the numbers and the growth rates, and over time, it was clearly going to be a big opportunity.
Right.
And you just had to make a decision about when did you want to jump in and be part of that.
Right. Okay.
And we kind of decided that, hey, we can be part of that starting around 2010, and maybe we'll be early, but we'll be there when it really hits.
And then did that pitch? I want to ask about that pitch. Like, did most of the LPs, were they US based or like local to the ecosystem? And then what was the original name? I think it wasn't 500. You had a few other conceptions of what that name was.
We were playing around with other names that were called Pirate Ventures. Or
is it really?
At one point, there were some Dune references like Sandworm Ventures.
Okay, right.
I remember a few of the other ones, but anyway, 500 Startups is one we ended up on. Heaton Shaw actually helped make that happen and grab that domain for me. I think we faced a lot of challenges because we were doing several things that were unconventional at the time. We were doing large portfolio like the name suggested.
Right.
We were investing globally, which wasn't really in vogue.
So on that one though, YC, Techstars,
they really started a little bit after us. I mean, we started after YC and Techstars. YC started 2005, and I think Techstars in 2006.
Yeah, right.
For the most part, their activity was domestic for quite a while.
Fair.
I think Techstars did a little bit of stuff in the UK and Europe, but
it's still US based. Yeah.
We were probably because Techstars and YC had started ahead of us. We had to sort of do something different.
Right.
So we made a big effort to go global almost right away. We were early investors in Mexico, Brazil, and India from the very beginning. We
is that right?
had partnered with some folks in the UK and Europe, Seed Camp and others.
Got it. So those are the easy sells, right, for LPs.
India's it wasn't easy. It wasn't easy at all.
Okay. Yes, take us back.
I would say we got a lot of crazy, people would laugh at me.
Is that right?
Because of the name.
Right.
And there are plenty of people who are like, I don't believe in large portfolio. I don't believe in the global thing. I don't believe in the accelerator story. So we were doing all those things. And, I was like, okay, 3 strikes, we're out.
That's right. Yeah.
So,
everything you didn't want, we're doing everything.
Our first fund was, we raised a $30 million fund. And there were certainly some folks who helped us get there. People that I'd worked with at Founders Fund, some other folks at Excel, Redpoint and Blue Run. Got some small checks from people like Mark Andreessen, Fred Wilson, Mitch Kapoor, and a few others, Josh Koppelman. But still, we probably spent almost 2 years raising that first fund. We raised from over 120, 130 investors. No single investor was much more than $1 million. So it was tough.
It was tough.
Tough road. And actually, that was true for the second fund and probably even for a good bit of the third fund before we really started to break through on something.
Okay, so because the framework that you're talking about is like it takes 5 to 7 years. Those 3 funds were
we raised a fund every other year. So
about 6
years. Fund 1 was 2010-11, Fund 2 was 2012-13, and Fund 3 was 2014-15. By Fund 3, we had started to get some traction with investors. We got a few larger investors in that fund that were family offices and some other folks. Government of Taiwan was a big investor. But still, I would say, we were doing hundreds of investments per fund, and most people thought that was crazy.
Right.
By the third fund, we were probably doing, if not 50% of our investment globally, at least 30, 40% globally. So we had probably done 500 companies outside.
Right. That's
by the third fund.
But wasn't that challenging as well with tax and legal?
I think that was certainly challenging.
No, it's challenging. That's just crazy.
And expensive.
Yeah, it's expensive. Yeah.
But I think from the beginning, we just look, we're making a long-term commitment to these geographies. We're going to be doing a large number of investments. We'll figure it out. That wasn't what most people would have done.
Right.
And because of that, nobody really tried to do that
Yeah.
because it was pretty hard. So because it was hard, it was a barrier to entry for other people to do.
Sure. Because people
also-
would focus on one geography at a time.
Maybe one geography,
Yes, yeah,
not multiple geographies. It's hard to hire. It's hard to figure out tax and legal.
Right.
So there's just a lot of reasons why most other people didn't do that. And certainly there hadn't been any real track record of success with that from anybody else as well. So, but I think, we kind of saw that there was an opportunity there. We thought it would work. I think looking back now, it certainly looks like it has. 500 Fund 3, I think we did close to 700 investments. Probably 25 or 30 of those look like they're on an IPO track. Half of those companies were outside the U.S. So I think Fund 1 and 2 were maybe 20, 30% global. Fund 3 was probably close to 50% global, and the results bear that out.
Got it. Interesting. Okay.
But, after a while, you sort of get old, and I don't know if I can keep up with doing hundreds of investments per year. So this is a little bit less insane on pace-wise. I helped do the first 1,500 or so investments. I think now 500 is probably close to 3,000.
It's all that portfolio management stuff.
Well, I think somewhere along the way, YC and Techstars also decided that large portfolio theory was okay and global was okay. And, I think starting when maybe Sam Altman took over YC, they started doing more stuff global.
True, but they would try to recruit and bring them to the U.S.
Yeah, I think mostly we're still U.S.-centric and bringing people here, but they did start doing a lot more investment in women, a lot more investment in
India,
Asia and Africa and India.
Yeah, that's right. Yeah,
they're doing a very large number of companies now. They're probably doing 400 or 500 companies a year now. So I think Techstars also started going global.
Right. So where is your thesis now on? We're going to wind up soon, but what is your thesis on global accelerator? Yeah, let's start with global first.
Well, I think now more than ever, people realize the global market is a big opportunity, and I think if you look at probably 5 large geographies in the global South, which would be South Asia, Southeast Asia, Latin America, Middle East, and Africa. Each of those markets, there are people going after it.
Right.
I think there's clearly validation for the U.S. and Europe, and I would say China and East Asia also.
Right.
But all 5 of those global South markets, which were previously people were pretty skeptical about, now at least there's some amount of activity going, and I think you'll see those markets continue to grow over the next 10 years or so. Because of that, there's more competition, and so now maybe it's not quite so easy to just jump into those markets. You really do have to have some edge or advantage.
Right.
I think the accelerator model is widely accepted, but also widely copied.
Right.
And so,
but the numbers.
Well, I think for some people, if you are willing to do enough investments and willing to wait long enough.
So is it still 500?
Well, I think 500 is still doing that successfully.
No, I mean, is it still that number?
I think probably 100 is probably the minimum requirement, at least 50 to 100.
Got it.
The numbers that we saw from 500, probably about 3% of our portfolio companies got to an IPO. Okay. Not that that's the measure for success, but I'm just saying if you are looking for a large outlier, they probably only happen single-digit percentages of the time. And so if you're only doing 10 to 20 companies, you're probably you might not hit one.
Right.
I think if you're doing maybe not 100 companies a year, but at least 50 to 100 companies over a couple of years, you have a reasonable, statistical chance of getting a larger outcome. Right. But I think it does require scale, and it does require perseverance.
Why do you say perseverance? In the sense?
Well, it takes 10 years for a lot of those companies to reach liquidity events, or at least the larger ones.
Got it.
And unless you've figured out how to run an accelerator, break even, or profitable,
that's tough.
You might not.
That's tough. Everything's bare bones already. Everything's bare bones already in accelerator.
I think we were smart about how we figured out some ways to make that.
I think you were. Yes, that's right.
But I think a lot of people don't really understand how long that takes, and some people are not willing to work on it for 5 to 10 years. I would say it's a minimum of 5 years, more like 10, to really see those results.
How do you talk to LPs about that? How do you communicate?
Well, I think that's the challenge for any venture fund, which is structured as a 10-year vehicle, maybe really more like 15 in many cases. That's probably true for accelerators even more so, just because you're starting earlier.
Right.
I think that's more obvious now. Maybe not everybody understood that
Yeah.
10, 15 years ago, but if you look at the larger programs which have had success, YC in particular, maybe 500 Techstars, Seed Camp, and a few others that are larger in scope, like there's certainly been a few smaller ones that have had success, but consistently being able to do that at large scale and globally does require commitment, large operation, and perseverance. There's now people that are trying out different models that might be a venture studio model.
Yeah, I've heard
some other people doing pre-seed models. I think there's all kinds of variations in venture that can work, but most all of them take time, and most all of them take a portfolio approach.
So the concept of accelerator still has value because it's the numbers.
It does, but I think it would be harder to do a global program now because there's established incumbents. So I think you're seeing more specialization. Probably on a geography, stage, and vertical basis. Maybe even on a set of services basis. And so probably we've seen more specialization, less generalist approaches these days.
Got it. Well, it's all the time that we have, but really you've been generous. But really, thank you for on behalf of the help you gave me and the talks and just being authentic. Really, I've never properly thanked you, and
well,
I always want to do a show.
You're responsible for most of that shit yourself, but happy to be a small piece of it and keep going after it. Good luck. Oh, okay, bring it in, buddy.
Hopefully you enjoyed this episode. And if you like episodes like these, remember to check out my episode with Linus Dog, where we talk about VCs and succession planning there, a topic that actually a lot of people don't talk about. So again, thank you for your time. Hopefully you enjoyed it, and see you next time.